Welcome investors and traders. So earlier today the Federal Reserve released an updated statement from the one it released in December, and they have removed and altered many key points that have injected a boost into the markets today. And personally, I feel that Federal Chairman Jerome Powell has given us everything that we could have asked for as investors within this statement. So as you can see here, the federal funds rate, which is the rate of interest that the central bank sets, is going to remain unchanged at 2.25% to 2.5%. This is still a very low rate, and this is exactly what investors wanted to see, as low rates means businesses can expand without expending huge amounts of capital on interest charges. So cheaper money means that businesses can expand and develop their business for cheaper, which is great for growth rates. This is down to a few things. As you can see up here, the inflation rate is at a near perfect 2%, although market-based measures of inflation may mean that that is a little bit lower if you measure it through the market, but 2% is perfect growth inflation rate. 2% is what most world governments are aiming for. So the reason they were going to increase interest rates was to combat massive inflation fears. So there's no need to do this currently, as inflation is sitting at a perfect 2%. So there's no need to massively raise interest rates to combat an inflation that doesn't exist at the moment. So this is great news. It means the Federal Reserve are monitoring the situation and are not stuck on autopilot in regards to the interest rates. So that is great to see, and investors are very happy with that, and you can see that in the markets there and the way it's reacted. They have also removed the language of gradually raising rates, which they've been doing since 2015, to a more favourable stance of being patient and waiting for the right time, which again has pleased investors, has been fantastic. This is due to essentially the same sorts of things, such as like global economic and financial developments and muted inflationary pressures. So in regards to the balance sheet that the Fed is talking about, their quantitative tightening is no longer on an autopilot program, as Chairman has suggested, and the FOMC, which is the Federal Open Market Committee, has made it clear that they will be monitoring actively and are willing to reconsider the program if the conditions so warrant it. So what quantitative tightening is it's the opposite of quantitative easing, and in the wake of the 2008 financial crisis, the Federal Reserve unleashed a $1 trillion injection into the US market to sort of incentivize growth and artificially grow the market. So obviously, as this is artificial, they now need to pull this money back out of the economic system. So that is what they've been doing slowly over the years, but obviously, as you can expect, with less money in the market, and especially to the tune of $1 trillion, this will have an effect. So they have to do this slowly and gently and not pull it all out at once. But that is what quantitative tightening is, and investors have been fearing that, but as the Fed has suggested now that they are willing to reconsider the program and they're going to keep a close eye on it. So that is sort of calmed some investors' fears that they are just going to keep pushing on no matter what, and this is sort of showing that they are not willing to hurt the market and they will keep an eye on the market. So this is showing a more flexible approach to this, and that they're willing to change the policy if necessary. But up here as well, it says the economic activity has been rising at a solid rate. Job gains have been strong, and unemployment rates remained low, and household spending has continued to grow strongly. And even the growth of business fixed investments has moderated in a rapid pace earlier this last year. So the business fixed investments has slowed down slightly, but still growing a little. All these things are fantastic again for investors. Fantastic news, and more people spending money in the markets. Sentiment is high around the markets, and all this, I think, the Fed's language in this statement and other pointers do show that we're not likely to encounter a recession anytime soon. But obviously nothing can be guaranteed, but these sort of pointers do point to that not being likely currently. There is currently just a 10% chance of a rate hike this year, which is about half of what was expected before the Fed released this updated statement today. And this is good for all the reasons previously stated, such as business expansion and real estate market and all of those things. So what this has led to is the Dow Jones has risen 437 points today to around 25,014. So it did manage to break that magical 25,000 mark that it dropped below in mid-December. So there's a few reasons for this. One of them is Boeing's strong numbers, as they're a large part of the Dow Jones. Also, despite Apple's reduced iPhone sales, they had growth in other areas, and the business is still fundamentally strong, so they have grown despite their earnings report. So all of these sorts of stocks that are bouncing back have pushed the Dow Jones to above that magical 25,000 number. And this is fantastic for investors. So the Dow Jones averaged out about 1.7% growth today. The S&P 500 got about 1.6% growth today, and the Nasdaq scored 2.2% growth today. So this is great if you're in the stock market. However, if you're in the bonds market, the 2-year Treasury yield is down about 6 basis points. So not so great if you're in the bond market, but that is to be expected, as they are not changing interest rates. This interest rate stagnation might affect bank stocks, as people were investing in bank stocks expecting their profits and revenues to increase as interest rates increased. But I don't think it's going to be a dramatic fall, as bank stocks tend to be fairly low, not as volatile as other stocks, but then you never know, so don't want to speak too soon. But anyway, thank you very much for watching the video. I hope you enjoyed the video, I hope you learned something. So if you did, like the video, comment, subscribe, make sure to comment any suggestions or questions in the comments below. Make sure to follow me on Twitter to get all the updates as soon as possible at StockInvestUK. And again, thank you for watching the video. I'll see you in the next one.